The common entry point really is education. And education means you got to speak the right language. You have to know what you're doing. You have to know how to analyze deals. You have to know how the process works. Whether you're a deal finder or a capital raiser, you have to be knowledgeable about the space. You can't call up a broker and go, hey, my name is Michael. I'm a real estate investor. Can you send me some deals? They're going to go, I get an idea. Why don't you send me your proof of funds and I'll send you what I got? Which is basically evidence that you just sound like a newbie. So don't do that, right? You need to educate yourself.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you love entrepreneurship and investing in real estate, then you are in the right place. Josh is the CEO of Freeland Ventures Real Estate Private Equity and has personally invested in well over 500 properties all across the country. He's also made hundreds of private lender loans and owns over 1,000 units of apartments. Josh is an expert at raising private money for deals, and he prides himself on never having had a boss in his entire adult life. Josh and his team also mentor investors and entrepreneurs from all over the world. He doesn't dream about doing deals. He actually does them, and so do his listeners and students. Now sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
Hey, welcome back to Accelerated Investor. How are you today? Wherever you're at in the world, whether you're traveling, having fun with your family, in the car, by yourself, listening, maybe at the gym. I appreciate you engaging with me in Accelerated Investor. Our podcast community and our Facebook group continue to grow like crazy. We appreciate all of you that have engaged with us and shared on social media. I'm excited to be with all of you today and to be interviewing and talking with my special guest. His name is Michael Blanc. He is the founder of Nighthawk Equity. He's a multifamily investing expert. He owns and manages over $50 million worth of multifamily assets. He's raised over $12 million worth of equity capital. He has an amazing podcast himself, and he's also the author of the Financial Freedom with Real Estate Investing book. Michael and I are relatively new friends. I actually met Michael through Jack Petrick, who many of you have heard on the podcast in the past, and Jack highly recommended Michael's Deal Analyzer. Michael and I connected a couple months ago, and so I'm excited to continue to build my relationship with Michael throughout this podcast. Michael, thanks so much for being here. Welcome to Accelerated Investor.
Josh, it's great to be here.
Absolutely. So, Michael, we connected through this Deal Analyzer, so I want to touch base on that first. So, Jack just talked so highly of it. I actually think you're using his testimonial on some of your Facebook ads, which is awesome. Jack and I are close personal friends. So why don't you just talk real quickly about what is this multifamily deal analyzer, and then we'll jump into your story and a little bit more about multifamily.
Yeah, when I first got started with multifamily investing, so back in 2007, it took me 4 hours to answer the question, How much am I willing to pay for this thing and why? And I didn't have the techniques we have today, and I didn't have this tool. And so I developed this over the years. And so as I started blogging about multifamily investing, I decided that the first thing that people really needed is a way to quickly analyze deals. And so the syndicated deal analyzer was born. At this point, it's probably the most popular, most widely used deal analyzer on the planet for multifamily. People, though, customize it for other asset classes like mobile home parks and storage and things of that nature. It makes it really, within 10 minutes, you can answer that question now. And it's also used to go very deep all through the contract negotiation and due diligence process. So, and then we use it ourselves all the time.
Fantastic. So you were able to take your 4-hour process and boil it down to 10 minutes. I'm sure people are going to ask me, where do I get this deal analyzer? So I'll definitely ask you at the end to plug that. We'll put it in the show notes. That'll be fantastic. So, Michael, you started in 2007, and people will think, wow, 2007 was a scary time. The market's at the peak. Then we went through the trough of 2008, 9, 10. So just let's backtrack a little bit more on your story. What was your first deal that you did? What was your attraction to multifamily? And looking back, How scary was it to be attracted to multifamily at that time in our economic cycle?
At the time, Josh, that's a great question. At the time, I was actually knee deep into restaurants. As I quit my job after a successful software IPO in 2000, put a bunch of money in my pocket, and then 2004 and a half, I read Rich Dad Poor Dad, and it ruined my life because when I was like, man, I need to get me some of this passive income, this financial freedom. And I was surrounded by people who were in the franchise restaurant business, and it's a cash flow business, obviously. And I was like, that's exactly what I'm looking for.
Yeah.
So I went all in. I went into a franchise restaurant. There's a pizza franchise, actually. And it worked well until about the recession, and it really kicked my tail pretty bad. Long story short, I subsequently lost all of my IPO millions in that experiment and added a couple $100,000 of unsecured line of credit debt to that on top of that. And I clawed my way out with real estate. And like so many people who were thinking real estate to do single family house investing, nothing wrong with that. That's what I did. And I flipped houses. At the time, I also got, I learned how to trade stocks and options, and I took a multifamily seminar, and I was basically learning from a fire hose. I was like, man, I'm going to learn 8 strategies at once and see which one I like the best. The problem was I was so deep into the restaurant debacle, didn't really leave much time for anything else. And then after the recession, when things finally started to quiet down a little bit, I was flipping houses and then got into my first apartment building deal actually in 2011. Now I had been raising money about 2 years prior to that because I didn't have any. So to fund the house flips, we actually had to raise money. So I learned the art and science of raising money, had this giant light bulb moment. So that's kind of the background. So I went through the recession, not so much holding real estate. I was flipping real estate, and I didn't actually get into apartment buildings. But I experienced the nightmare and the panic of owning a small business that was losing lots of money every month because of the recession.
Yeah, we went through the same thing. We started investing in real estate in 2004, but Cleveland at that time was already in a foreclosure crisis because we had a bunch of large Fortune 500 companies that had all left town. So there was more inventory and people losing jobs left and right starting in like 2001. Wow. And there were massive companies like BP Oil left town, went to Chicago, and I can't even remember all the companies, but there were like 8 or 10 large Fortune 500 companies left town or consolidated or moved out of the area or flat out went bankrupt. Like the steel, Ramey, what was the steel company in the middle of town? LTV Steel, yeah. So all these companies are gone, and all of a sudden there's all this inventory, and everyone's like, we were getting calls for multifamily. Michael, you know how it goes, and you're like, well, you know, how much do you think your house is worth? Well, it's probably worth about 125. What do you owe on it? I owe 150. You're like, oh shit. You're like, I can't buy that unless I do a short sale. So we learned before the crash of 08, 09, how to do short sales. And very similar to you, we were very transactional through the recession. So we did well in the recession. And then after that, coming out of that, this last 10 years has been quite a nice cycle rolling up. So 2011 rolls around, Michael, and you're digging your way out of this debt from the pizza business. You're starting to see, buy my first apartment building. Tell me about the first apartment deal. Everybody remembers their first big deal, whether it's residential or multifamily. What was that like? How many units was it? How did you structure it?
Yeah, I remember it clearly. I like so many first deals, right? It was a 12-unit building in Washington, D.C. And I remember, driving up to it. I put it under contract without having seen it. That's what we do. Right. And I pulled up and I was like, oh, my
God. So proud of myself. I never saw it.
I never saw it. I put it under contract. And I remember driving up and looking up at this 3-story building. I was like, oh, that's a big house. Oh, my gosh. And I started freaking out. And then what I noticed that within 10 days or maybe 7, I was there every day. I was talking to people. I was interviewing people, contractors, property managers. All of a sudden, that 12 unit shrunk in size to me. And I was like, man, this isn't so bad. I wish this thing were bigger. And I was just fascinated by how quickly my comfort zone grew. And it was essentially a nightmare first deal. And basically every possible respect, if you think of something that could have happened, there's a 90% chance it happened. We got through it. And then what happened is just started sending me mailbox money. And meanwhile, I was flipping houses, which the problem was that I was making great money with the house flipping stuff, but it was so much work. As you know, I couldn't take 30 days off if I wanted to. It was always someone quitting, someone screwing up, not showing up. And we had all the systems in place where we're buying stuff sight unseen. I had agents trained and PDF contracts automated, all that stuff. But really, it was a very active, very exciting business. And I just noticed that the apartment building was just quietly sending me mailbox money. And I was like, man, I didn't get into this thing to create myself a job. I wanted financial freedom, meaning that I could work whenever I want and stop working whenever I want. And I was like, daggone it, I gotta stop doing this and start doing more of that. Meaning apartment buildings. And that's kind of when I shifted. I was like, you know what, maybe I'm going to start slowly, ratcheting down the house flipping stuff and really start looking and thinking more about apartment buildings as a strategy. And that's exactly what I did.
Nice. Yeah, it's often like when we take a moment to reflect, it's fun to record this and be with you at kind of the end of the year, 2019, because this is about the time when everybody or people that are thinking in advance should be thinking and reviewing. And often it's as simple as looking at your balance sheet, right? You look at your balance sheet and say, I've got this apartment building that's giving me this equity and this income versus I put all this time, effort, and energy into wholesaling and flipping. And it's awesome. So many people I know start in wholesaling and rehabbing and rentals. And eventually pretty much everybody says, you know what? Like my duplex or my quad or my 10 unit is so awesome because it just pays me all the time. And then there's this epiphany, boom, that happens. Like, wow, I should really focus more of my time on multifamily. So what do you like best about multifamily these days? Now with a $50 million portfolio, lots of money raised, a hugely successful podcast, you do massive live events. What's your favorite part about the multifamily business?
Yeah, I just love every part of it. I'm really having a lot of fun. I love the art of the deal. I always have. I just think every deal is different. You're always problem solving as an entrepreneur. That's what we do best. So every deal is a little bit different, gives me variety. I also like the educational side of things. I like helping other people do something that didn't think was possible before. In this case, doing their first multifamily deal. And our mission is to help people become financially free, quit their job, which they can do once they've done their first deal. They essentially automatically do deals number 2 and 3. Right. And most people have covered the living expenses. And that to me is super, super satisfying. So I really like the variety of it. Frankly, I like the challenge of it. One day, we're visiting a property and we're, evaluating whether we should close on this. The next day, we're doing a podcast or a live event or a coaching session. And I love all of it. I love everything. It's different, but all synergistic. It all kind of works together.
Yeah, fantastic. So in every multifamily deal, there is sort of the active operator who typically finds the deal, operates the building, brings in the team, brings in the contractors, brings in the leasing agents, and then you have passive investors. And we find that a lot of people kind of just fall into whatever bucket they fall into. We deal with active deals of ourselves. We own 2,400 units. We are also a passive investor. We have $10 million just in multifamily. And so help our audience understand, if they've never done a multifamily deal, whether they're active or passive, like how do you help define those? How do you help people, your students and your investors, find out which bucket they should fall into based on their goals, based on the money that they might have, the difference between the two, active versus passive, and how do you help people kind of fall into the bucket where they should based on their current life experience and their current place?
What's interesting is that both active and passive investors want the same thing. And I know this because I've talked to them and I've studied them. They really want passive income so they can quit their jobs. So the only difference between the two of them is that the active investor is a hustler and they have some money, they don't have a ton of money. And the passive investor tends to have less time and more money to invest. But they both want the same thing when you talk to them. They want passive income so they can quit their job. If they're a dentist or an attorney, they want to quit their practice or their law practice and things of that nature. It's just the way that they're getting there is different, but the vehicle is the same, which is multifamily. So multifamily appeals to a very, very wide audience. Now, what's also cool is in the active investor side, there's actually 6 or 7 different buckets in that, which I find really cool. And you are actually in several buckets yourself. So one bucket, of course, is the classic syndicator, right? This is the operators who are finding the deals, they're raising the money, they're operating they're managing the asset after close. It's a classic. However, that's not necessarily the norm anymore because you can specialize within that. For example, you could become a deal finder. You could do nothing but analyze deals and talk to brokers and get really good at underwriting and pre-negotiating and negotiating deals. Almost a little bit like a wholesaler would in some sense. Sure. Instead of wholesaling and selling the contract, though, you basically become a general partner and you partner with an operator because you might not have any interest in managing anything after it closes because it really bores you to tears. Right. On the other hand, you might hate Excel spreadsheets, for example, which is really important as you're analyzing deals, but you're a relationship person. you might gravitate more to raising capital, meeting with investors, going to lunch, going to dinner, hosting a podcast, a meetup, whatever the case may be. And through maybe your own investing experience, maybe you're investing passively, you are so excited about doing this that you want to tell everybody about it, because investing in multifamily syndications is the number one best investment on the planet. Cash flow, consistent, predictable returns, and extraordinary tax benefits. Why would you not share that with people who are thinking the stock market is it? And so you have these different these different kinds of active roles that you have. And to answer your other question, which one do you go to? There's really two ways to answer that. One is, what are your strengths? What do you love to do? And on the other hand, where is the current opportunity? So, for example, like I said, if you don't love Excel spreadsheets, then maybe you might want to stay away from underwriting deals, or maybe partner with someone. Again, if you love spreadsheets, you have a very unique skill set that someone who's looking for deals or looking to raise capital. And so what's happening is there's a lot of joint venturing going on. You might have a relationship person, capital raiser, partner with an underwriter, analytical person. Those partnerships work really, really well because they're both required. And so we see a lot of partnerships happen between deal finding and capital raising, and then a third through the operations side. So the thing that actually happens after the operation, after the closing. So there's so many different ways that people get involved, both on the active side and on the passive side, to achieve the same goal, which is passive income and financial freedom.
In my newest real estate investing book, The Flip System, you'll learn the proven secrets and strategies that I've used to be a successful real estate investor. You'll also hear the story of my journey from quitting my job to doing over 2,000 units of apartments. The Flip System is now available for a limited time, and you can grab your free copy at getflipsystem.com/podcast. You'll learn the same proven principles and secrets and investing strategies that I used to quit my job and pursue a life of financial freedom. In this book, I'm sharing exactly how I was able to personally close over 750 profitable real estate deals, make over 400 private lender loans, raise over $30 million, and acquire over 2,000 units of cash flowing apartments. Get my newest book now for free at getflipsystem.com/podcast. That's getflipsystem.com/podcast. You know, when you see posts on Facebook, and a lot of our friends are, you're buying multifamily, we're buying multifamily. A lot of our friends, people that we know from different live events and podcasts, and just guys that we know from masterminds buying multifamily, when they close on a multifamily deal, you typically don't see one guy standing like in front of the name placard of the building. Yeah. Usually it's like 6 people, right? Yeah, me and my partners closed on this deal because, like you said, everyone's playing a different role. Maybe one guy signs the GP, or the PG to guarantee the loan. Another guy's raising money. Another guy is doing the operations. Another guy found the deal. Several people are doing asset management. Several people are raising money. Everyone's playing a different role because the deals are so big, right? $10 million, $20 million, $50 million deals. There's enough kind of juice in them for everybody. So if somebody's getting started with multifamily, and I love to ask this question, especially from somebody that's been around so much multifamily like you, when somebody's just first getting going, maybe they're just going directly into multifamily, or they're pivoting from single family resi over to commercial and multifamily. Is there a place where you recommend that they start? Do you recommend they kind of start as a deal finder, or building relationships, or calling on brokers? Where's like the common entry point, if you will?
Yeah, the common entry point really is education. And education means you got to speak the right language. You have to know what you're doing. You have to know how to analyze deals. You have to know how the process works. Whether you're a deal finder or a capital raiser, you have to be knowledgeable about the space. You can't call up a broker and go, "Hey, my name is Michael. I'm a real estate investor. Can you send me some deals?" They're going to go, I got an idea. Why don't you send me your proof of funds and I'll send you what I got? Which is basically evidence that you just sound like a newbie. So don't do that, right? You need to educate yourself. And there's a lot of great resources out there. We have training and coaching and books and that thing. It's not super expensive. But you have to, you do have to invest in yourself so you don't sound like a freaking blubbering idiot. Yeah. Now, once that's done, you got to pick your track. A lot of people pick both tracks at once. They will start calling brokers, analyzing deals, and they'll start meeting with investors. And then they kind of see what they like, what pans out more. And then from there, they may continue both tracks. A lot of traditional syndicators do both tracks at the same time. And then some people might say, well, this capital raising thing is for the birds. I really don't love dealing with people, and I'm just going to find deals, and I'm going to build my team that way. Other people are going to say this Excel spreadsheet stuff is for the birds. I'm going to align myself with an underwriter, deal finder person. I'm just going to raise capital for other operators. And that's kind of what you do, Josh, as well. You align yourself with a small number of really high quality operators that you know are going to do a good job, and you do what you do best, which is raising capital, and everyone's happy.
Right. Yeah, you bet. When you get into real estate, you create this sort of love and affinity for real estate, the challenges it presents, but also the upside, the tax benefits, the depreciation, the appreciation, the principal pay down. There's so many different benefits to owning real estate. The downside is that it's not super liquid, right? So the stock market, when I talk to passive investors, I try to present the positives and negatives of each type of investing. Most people, whether they're doctors, whether they're just salespeople, nurses, teachers, all the way up to the super high accredited, high net worth, most of them are very, very, very familiar with common stock market investments. And I have this whole process I go through to break that down and to show them why investing in stocks, bonds, and mutual funds, why they do that is simply because we've been conditioned over the last, let's say from the time we're 8 or 10 years old, and we hear from our parents for the first time about money, all the way through however you are old today. You've been conditioned by advertisements. You've been conditioned by your 401k at your former employer. You've been conditioned by your parents. You've been conditioned by your friends who invest in their 401k, all to invest in the stock market. But the truth is, stock markets average a 9% return if you're in large cap stocks, 9% for the last 100 years. And if you're in a blended portfolio, most financial advisors, when they do a diversified analysis of your thing, they're going to tell you should be in a blended portfolio. Blended portfolio, talk to any financial advisors, they're going to tell you you're going to get 7% return. Stocks, bonds, mutual funds, all together 7% with almost no tax benefits, right? But the benefit to that is that it's liquid. You could snap your fingers and sell a stock today. So when you're talking to passive investors or your students, Michael, about the stock market versus real estate, what are some of maybe the little one-liners, the little zingers, or some of the education that you do for your students and for your investors to help them really understand? It's great to be liquid. It's great to have some money in the stock market, but nobody ever got rich, except for Warren Buffett maybe. Nobody ever got rich just purely investing in stocks. There's so many more people that create financial independence through real estate. I know it, you know it, but what are some of the maybe tips or some of the things that you teach your students and your investors to help educate them in this conversation of stocks versus real estate versus multifamily?
You've identified the one and only drawback of investing in syndications, which is lack of liquidity. That is really the one and only drawback for that. However, the benefits of investing in syndications outweigh by so much that drawback that it's a no-brainer. Look, stocks don't generate cash flow unless you're very advanced and you're selling puts and calls, and no one does that, right? So stock markets don't generate cash unless you count interest and dividends, which doesn't make any sense. So syndications generate significant cash flow, between 8 and 10% of invested. That's pretty amazing right there. Number two, the returns are far higher than the stock market, and they're consistent. With stock market, you're dealing with volatility that over time actually decreases your returns. So you have consistency. And number three, you have tax benefits that are extraordinary.
Yeah.
I mean, it ends up that you don't pay any taxes at all on any kind of distributions because of the way tax laws are. Obviously, with stocks, you pay capital gains when you do. You don't have that issue with syndication. So the pros outweigh by far the cons. And the question is the following. I mean, the counter is, why do you want to be liquid, really? The only reason you want to be liquid is if you want to get out of one investment and into another. Well, If you're in a great investment, why would you ever want to sell anything? I had the pleasure of actually interviewing Grant Cardone just not too long ago, and he says, back to your one zinger, don't save to save, save to invest. And he's got this crazy little millionaire book, and where he basically says, stay broke. Like that's his headline, like in point 7, stay broke. And I'm like, what the heck does that mean? Basically, it means that you shouldn't have any liquidity anywhere. Anytime you have liquidity, it's a bad sign that something is not earning the way it should. So what he does is he takes once a year or twice a year, he plows everything he possibly can into investments, businesses, and most recently, multifamily syndications. So he's got no cash. And what that does, not only is his money working harder, but it keeps him going. So he doesn't have like $10 million. He doesn't have $10 million in the bank because he's literally broke. He doesn't have that kind of cash laying around. So therefore, it motivates him to hustle more and generate more cash because he's got to build up his coffer again. I found that hysterical.
That's awesome. You know what's interesting, Michael, about that? I remember being a financial planner. I was a financial advisor, a fee-based financial planner. I used to charge my clients hundreds, if not thousands of dollars to write a plan. I was in my early 20s. But I remember hearing from one of the advisors up on stage that said, you know what, like, if you want to get motivated in this business, that he was talking about financial services, go buy yourself an expensive condo or apartment and go buy yourself a Porsche and then go find a way to afford it. And that I thought was, looking back, it's like, well, what Grant is saying, what you're saying, Michael, makes way more sense. You're actually investing in things that create cash flow. What he was saying, though, was very similar in that just like level up your lifestyle, level up your expenses to create motivation. I think the point here I'm trying to make is both of them create motivation, right? And when I hear people that are like, well, I'm not investing because I'm pretty comfortable. And Michael, you know it, I know it, comfort is the enemy of growth.
That's right.
Right? So whether it's investing all your money and having no cash, so you have to hustle to create more cash, or whether it's taking on some expenses, it's great when you can actually invest in assets like multifamily that creates cash flow that you can then turn around and buy things that you like, buy the toys, right? So what the advisor got wrong, and it's interesting to hear from an advisor that was telling the audience, go buy a Porsche, versus what we tell our members and students, which is go buy the asset and let the asset buy the Porsche, right? That's where it's really at. Michael, let me take a step back for a second, though, and go back to 2011, 2012, 13. You're starting to build your multifamily portfolio. Maybe just help our audience understand some of maybe your fears, some of your anxieties, if you had any, around raising money or around making offers on big apartment deals, building your portfolio. What are some of the common fears that you see some of your students have and some of the personal fears that you had to overcome making the pivot into multifamily and just saying, like, I'm good enough, I'm smart enough, like I can do this, I can buy bigger buildings and raise more money? What are some of the fears and some of the, maybe the mental walls that people put up and some of the excuses why they don't jump into multifamily sooner?
Yeah, and they really are made up, fabricated fears, like you're talking about. They're really made up because they're not actually real. But in your mind, as many fears, they actually are really real. One of them is, should I take friends and family money? Or no, I should not take friends and family money because, God forbid, I lose friends and family money. That's the worst of it. And that's, again, a fabricated mindset, because why would you take anyone's money and lose it? Like, it doesn't make any sense. Either way, it's going to be a bad situation. So it's kind of a fabricated thing. And if you say, look, I'm not taking friends and family money, you really cut yourself off at the knees with regards to getting started with the art of raising money. It doesn't make any sense at all. And again, because of the asset class you're in multifamily, because of your education, the probability that you will actually lose people's money is very low. What may happen is you may not make as much money as you projected, but multiple bad things would have to happen all at once for you to actually lose principal. It's just not that high probability. Number two, though, is the fear of actually raising money. And what are you doing to protect yourself and your investors from a deal going bad or the market going bad, right? And so you got to make sure that you have steps in place to do that. Things like, for example, always buying for cash flow from day one. Don't buy something that doesn't cash flow. Make sure you have the right debt product on there so you're not forced to sell or refinance like so many people did in 2008. Making sure you never run out of cash. Okay, you never want to run out of cash. So having enough cash at closing, taking out cash during the operation, stuff like that. You're putting safety nets in place all along the way to protect the investors from losing their principal. So those are some of the major ones. And then other things around confidence. Why would anyone give me money? I don't want to beg for money. And that again is a mindset thing where you're not begging, you're actually providing a service. You have an opportunity that is so unique in the world that only you know so much about, and you're educating, you're sharing your enthusiasm with investors who know nothing but the stock market. And as we know, the stock market is fundamentally flawed in many different ways, and you can help people achieve consistent income and pay less taxes. I mean, as a high net worth earner, I want to hear about that, right?
Yeah,
you are actually being selfish by withholding that information from your dentist, from your attorney, who otherwise would not know about that.
I had a friend of mine, Michael, years ago. His name is Francis Abalola. He actually works with a mutual friend of ours, Tim Bratz. And Francis told me, this is going back 10 years ago, and I'm not sure where he got this from, if it was a seminar or a workshop or a mastermind, but he said to me, we were talking about sales and the conviction of sales, or the conviction of raising money, or the conviction of selling education, coaching. And we were talking about some of the let's say the haters or the trolls that will say, well, if you're so successful, why do you coach? Or if you're so successful, why do you raise money? And it came down, we were talking about conviction, and he said to me, I'll never forget this. He said, Josh, I learned long ago that if you have something that will impact somebody else's life in a positive way, and you have a conviction that you know it's good for you and good for them, you have a moral obligation to sell it to them. Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast. So you have a moral obligation to present it to them, because if you don't, you're actually withholding an opportunity that can actually positively impact their life. And I think that conviction, the difference between I'm begging people for money and I'm providing them an opportunity, or I'm begging for money and I have a moral obligation to present this to them because I know it's going to enhance their life. That's where it's that small pivot in our own mindset, right? So again, help me understand, like when you're educating someone, coaching your audiences, your team, how do you help them? How do you help them just convince themselves? Because at the beginning, they're like, multifamily is awesome. I know I want to do it, but I'm still got this fear. I still have this roadblock. We got to punch through it.
A lot of times I find that when someone can visualize the process played out, if I describe to you the money raising process, what are the 10 steps or whatever to raising money, maybe some scripts to use, what to say, how to find the investors. Once people see that, they're like, oh, that's not so bad. And then I couple that with, here's some other people that were in your situation that had maybe your job or your whatever, and they had similar problems, and look at them now, right? So once they visualize this, belief starts to creep in, and belief is what you need to do anything meaningful in life. And belief is at the opposite end of fear, right? You can't have paralyzing fear and belief at the same time. It doesn't make sense. So what happens is you really need belief that the system works, number one. But oftentimes that's not the problem. Oftentimes people think that I can't make this work. I'm not good enough. I don't have what it takes to do it.
Right.
And getting that belief is again, the way visualizing it and having them talk to other people who have done it, who have maybe shared their mindset with them. And they're like, my gosh, I used to think the same thing you did, but here's what I did, and look at me now. And they're like, no way. And coupled with, especially if you're working with a mentor, especially a paid mentor or a coach who's done this, I can't remember. I for example, I'll never forget years ago, back in the restaurant days, I had someone who was an experienced restaurant guy. And I was like, man, I don't have the money to open up another restaurant. He goes, that's fine. I'll help you raise it. You can do this. And I'm like, really? And I'm like, well, right. He never ended up raising the money for me. I had to do it myself. But he gave me a belief that I can do that. And so an experienced mentor coach can do that in a person. And from that point on, it's just they're going to get it done because now they believe in themselves and they see how they can be successful.
Yeah, that's fantastic. You got to visualize. You got to have the knowledge first, right? And then it comes down to belief systems. I think it's interesting that belief systems, the acronym of BS, right? Belief systems, bullshit, BS. A lot of times our belief systems, they're bullshit. It's BS. It's stuff that we concocted in our head from some experience that we had in the past or some experience that we haven't yet experienced or had. And we concoct this belief system, this bullshit in our minds that we think that we can or can't do something, right? The truth is if Michael Blank's raised money and Josh Cantwell's raised money and all these other people have raised money, you can do it too. Period to the end. If they've invested in multifamily, you can do it too. Michael and I often tell people, Michael, what makes you so special? What makes you think you're so special that you can't do this?
Yeah, that's exactly right. Yeah, that's right. Now, the thing is, look, everyone is kind of unique in some way, and I may or may not resonate with someone, right? Which is why it helps to have different success stories. I mean, certainly, if you and I say, oh, well, we've done it, so can you? People are going to go, yeah, but look at you already own 2,400 units. Like, it's easy for you to say. Right. Versus saying, well, Sam did it. And he did his first deal only like 2 months ago and he did it. You're like, oh, well, now maybe I'll pay attention. So you really have to show people someone who has been in their position, relatively recently, so they can resonate with that person. And that's what triggers, that's what makes people believe is seeing that.
So Michael, tell us about somebody recently. You have experience with a lot of new, intermediate, and advanced multifamily investors. Maybe tell us a story or two about one of your most recent success stories with one of your students or members.
Gosh, I mean, there's so many, and I loved, there's so many. Some people say, oh gosh, I'm too young to do something. There was, Jake Volan, shout out to Jake, great guy. He was a 21-year-old Air Force cadet, and some miracle, he was invited into the best and final of an $11 million deal. Like, how did he do that? Right? Yes, he educated himself. He went, he bought our program and we didn't know about it until he brought us to the deal desk. We have a deal desk process where people can bring us deals and we partner with them. How did this guy manage to be taken seriously as a 21-year-old, right? It's just amazing. Anthony Metzger is similar. He's a 29-year-old winemaker, for crying out loud, right? Has never done real estate before. He educates himself and he makes these brokers believe that he knows what the heck he's doing. He's following our process, yes, but he wasn't the mentoring student at the time. He brings us this deal, and this was actually an $11 million deal, and we closed on that about 2.5 months ago. So it's like these stories like that where people, they educate themselves, they acquire the knowledge, then they get belief in themselves, and then they develop the confidence. Now they call up a broker. And they're taken seriously by the broker because they're using the right language. They've assembled a team around them. All of a sudden, they're like, yeah, sure, why don't you make an offer? And all of a sudden, before you know it, they're awarded an $11 million deal. I mean, it's really, really unbelievable. And there's story after story like this where people who have never done real estate or people who have done single family, it doesn't really matter. Like, I don't see a pattern at all, correlation between it all. And they're doing their first deal. And then the law of the first deal triggers I talk about a lot is that once you do their first deal, the second and third essentially follow automatically. They just fall in your lap because now brokers are calling you, investors are calling you, and you'd have to expend more energy not to do the second deal. Yeah, and so, and because these deals become subsequently larger, most people are covering their annual living expenses in just 3 deals through a combination of acquisition fees and passive income, and then they quit their jobs. And that's really what I'm about. I'm all about helping people quit their jobs with real estate, but maybe not in the way they think, which is typically single-family house investing. Yeah,
I love it. And you know what, that story, Jack Petrick, which is our common friend that connected us.
Sure, he is another example. I forgot about him, yeah.
He's exactly like, and I funded a bunch of his deals, his smaller deals, because we do a bunch of small balance commercial lending. We fund a lot of deals in that $250 to $5 million space as a first mortgage lender. And Jack had done like a 20 unit and then a 24 unit and then a 35 unit and a 16 unit. And then all of a sudden he had closed a couple of tough to close smaller multifamily deals.
Right.
That a broker brought him an off-market deal, 164 units, $12 million deal. Then Jack and I partnered on that. We closed that deal together, 164 units. And again, it was just like you said, because It was the first deal trigger. We had closed one and then two, and I had helped Jack raise some money for one, and then I had funded his deal as a private lender on another. And then all of a sudden, kaboom, 164 unit deal in an A-class market, an A-class property, but that needed some value add, needed some opportunity for some increases in rents. And boom, now, when you close on a $15 million deal, now every broker is going to look at you and take you pretty seriously. And they are. Now he closed an 89 unit that we just funded, 123 unit he's closing next month. And I want to think a lot of this started with your deal analyzer.
It did. He actually went through our course. Actually, I was looking at our notes real quick. He started with our course, and if you would ask him about the law of the first deal, he'll know exactly what that means, and he'll probably say something like, "Yeah, within a few weeks of closing the first one, I already had the second under contract."
Absolutely,
or some derivation thereof.
Yeah, that's absolutely right. True. So, Michael, as we kind of round third here and head for home, one final question for you is just, what are your thoughts on the state of today's economy? Trump is in office. There's an election year coming up next year. There's a lot of riffraff in this impeachment talk. There's a lot of comments about China and trade war. We get a lot of analysis, usually once a quarter, from some of our insiders on the state of the economy. I think there's a lot of positives. There's certainly our economy showing some cracks in confidence in manufacturing. So I'd just like to get your take on what do you think is going to happen here maybe in the next 1 to 2 years, and how does that impact your multifamily thought process?
Well, everything we do, we always are very cautious with what we do. Everyone is kind of predicting some kind of market correction, not so much for any particular reason, but simply because we appear to be overdue.
Yeah, we're overdue. This has got to happen sometime.
We're overdue, therefore it must happen. Like 2020 appears to be the magic year. However, no one can really say, well, why exactly? Where in the fundamentals is there a crack? Sure, yes, manufacturing is a little soft, but there's tariffs going on, right? Now, going into election year, there's going to be an uncertainty, and uncertainty always breeds massive amount of volatility, especially with the stock market. Not so much with real estate, with the stock market, uncertainty until the elections are over and things will quiet down again. Yeah. People are predicting a market correction in 2020 again. No one can really say why that is. However, to me, it doesn't really matter. Let's say it happens. In my mind, it's only good. It's only positive. Yeah. Because when we're buying apartments for the reasons I mentioned earlier, we really buy apartments for the medium term, 5 to 7 years, so that we can ride out anything that may happen in the meantime. If my property is cash flowing, if the valuation goes down over the next year or two, it doesn't matter to me unless I have to refinance or sell, which I don't because I have the right financing in place. So I don't really care too much about that. Now, what may change is instead of my 5-year hold, it may turn out to be a 7-year hold. And so some investors may not be very happy because I told them it'll be a 5-year hold. However, most are like, I'm so glad you didn't have to sell in some kind of short sale and get the heck out of there that you were able to hold on 2 years later. So I don't think anyone's going to be so upset over that. The reason I'm saying it's going to be positive is because it's going to open up more opportunities to buy stuff. And that's really what we're looking for. It's a little bit overheated it's a seller's market right now. So a correction would balance that out a little bit more. On the other hand, my gosh, interest rates went down a couple months ago in an incredible move downward, and we're like, oh, cap rates are going up, and the only reason we're saying that is because, well, how can they possibly go lower? Right. Well, the other thing was interesting so interest rates are going down, so that means that cap rates are going down with the fall of interest rates. But what happened last year early in December and January, there was a spike in interest rates, and what happened is cap rates stayed exactly the same. And that was very interesting, which demonstrated to us that there's so much demand for multifamily. There's so much cash looking for a home, and that includes 1031 exchange money. It includes foreign capital, and that kept the cap rates and the prices at about the same valuation, even though for a period of time, interest rates went up by a whole % for about a period of 6 weeks. And that was very interesting. Yeah, so my prediction over the next couple of years is, with regards to multifamily commercial real estate specifically, is stability. So stability. I don't see anything major going on. Having said that, though, we are always cautious with how we buy stuff because you never know. And you were through 2008. I was through 2008 and you're like, man, how much worse can it get? And then it got worse. And you're like, oh, I don't want to go through that again.
Right. Well, that's the whole reason why we're buying these assets now, right, is to create cash flow to get through a recession. You can get through a recession with cash flow. And like you said, the only time you lose is when you have to sell at the absolute worst time. And we're going to avoid that with cash flow, right? Yeah. If you have 5, 7, 10-year asset, hold on to it for the long term. Many people, when they're in stocks, right, they're like, oh my God, the market's down, I better sell. Like, shit, don't do that, because if you sell at the bottom, then you just experience the loss versus just holding on to it through the whatever time you're going through. So, Michael, listen, I had a phenomenal time just getting to know you more, doing this interview. I look forward to, being at some of your events, meeting more of your students and members, more people like Jack and others. I did want to give you an opportunity to talk a little bit more about your events, about your book, your podcast. You've got a number of different assets and different places where people can connect with you. So what are some of those different places people can reach out and just learn more about you and your organization?
Yeah, we have a ton of free content out there really designed to help people, educate people about the multifamily space, to answer the question, hey, is this something I should consider or not? I think a lot of people have a closed mind to investing in multifamily because they think it's some advanced strategy that need millions of dollars and years of experience. None of that is true. So we have a lot of these free resources. We have a blog, we have the podcast, we have a free ebook called The Secret to Raising Money to Buy Your First Apartment Building Deal. You can get that all on the website, themichaelblank.com, and that's Blank. It's written blank. I just pronounce it funny. And a good entry point is probably my book called The Financial Freedom with Real Estate Investing, which is this yellow book. It's on Amazon. And it's really, everything kind of is in one place to help answer that question and to paint the picture of what it's like to raise money and close a deal, to try to just to see if that's something for you, something you should consider either as a complement to what you're doing right now or something entirely new.
Fantastic. And the deal analyzer, we talked about at the beginning. Can that also be found on themichaelblank.com?
It sure can, or you just punch in deal analyzer, and it'll take you to my website. So yeah, you'll have the deal analyzer. We have the courses and mentoring, and the live events. Our annual event is called Dealmaker Live. It'll be July 16 through 18 in Dallas. In the middle of summer.
I will be there. That sounds awesome. Well, listen, Michael, thank you so much. I'm so grateful that you took some time out to spend with me and with our audience and share all this amazing insight on your journey in the multifamily space and a little bit on the state of the market. Just thank you so much for taking the time. We're so grateful to have you on.
Josh, thank you so much for having me on the show.
You've been listening to Josh Cantwell and the Accelerated Investor Podcast. Leave a comment on our iTunes channel and let us know what you want to learn next or who you'd like Josh to interview. While you're there, give us a 5-star rating and make sure to subscribe so you can be the first to hear new episodes. Follow Josh Cantwell and his companies, Strategic Real Estate Coach and Freeland Ventures, on all social media platforms now, and stay up to date on new training and investment opportunities. To start your journey toward the lifestyle you've always dreamed of, apply for coaching at joshcantwellcoaching.com.